Hey, good morning, everyone. Marty Mazzora here, Friday, the 27th of June, 2025, with your end of week update. Today, we're going to look at some data that were released today about personal income and inflation. You can see the snip I have on your screen there. We're going to spend a little bit of time on the topic that I wrote about on Wednesday that you got in your email, clients. And then we'll do the usual, look at the technical picture for stocks, the dollar, gold, and treasury yields. So to start out with, let's just jump on to the data of the day, and that was the PCE data, personal income and outlays, and the deflator, the inflation measure. And this is the one the Fed says they pay the most attention to. So personal income took kind of a walloping, which is interesting. So the consensus expectation was that it would rise by 0.3% on the month. It actually declined by 0.4%. Now, there is an explanation there, and it had to do with, I believe they called it the Social Security Fairness Act. A not small group of people who had paid their FICA taxes at some point during their working histories then moved into employment that did not pay FICA taxes. We see this most often in schools with teachers who have their, in California where we are, have their state teachers' retirement, but they don't pay into Social Security. So they would previously take quite the hit, meaning they would get just a small fraction of what they had earned under their previous Social Security wage experience. So that got fixed. So folks in April saw quite the boost in their income, and they got paid back for some previous time as well. So the transfer payments, as they're called, the government transferring monies to individuals, that component in personal income kind of fell off of a cliff a little bit compared to April. So in May, you didn't have that big catch-up payment happening, so you had incomes drop via transfer payments. Nevertheless, when you look at it, doesn't show it here, when you look at it without that transfer payment anomaly, you still are down 0.1% when it was expected to be 0.3%. So take that out, and it was still surprisingly poor in terms of personal income. Personal consumption expenditures, consumer spending was expected to rise by 0.2. It declined by 0.1. The consumer price index, the headline index, was up 0.1% as expected, 2.3% annually. The core, which X's out food and energy, was expected to be 0.1%. It was actually up 0.2%, and year over year, 0.7%. So on one end, very short-term data, but trends are showing more of this. I've been telling you, we don't think that odds of recession are all that small like so many people seem to. In fact, the recession camp looks pretty empty right here for the second half of the year. Well, I should say, other than what you're hearing, from folks on the Fed. You're starting to hear that a member or two of the Federal Reserve are warming up to perhaps a rate cut in July. I doubt that very seriously. I think September is very much on the table. But this is the kind of data that would support that. However, this is the kind of data that wouldn't. So let's drill down a little bit further in the inflation data. So this is from the source itself, the Bureau of Labor Statistics. And as you can see here, we're breaking down the all items, major categories. Here's your food, up 2.9% annualized. Big drop in energy, down 3.5%. And then all items, this is your core, up 2.8%. Well, since we all eat, let's look at what food prices are doing. So here's your food at home, up 2.2%. Folks who are eating out, and people are still doing that in droves at nice restaurants anyway, up 3.8% over the last 12 months. We want to look at it on a 20-year basis. We would just click food here, and you can see the trend of late is, higher when it comes to the cost of eating, right? And going back to all items, of course, thanks to the big drop in energy, it's been trending lower, although up here, as we see here on a month-over-month basis. And there's your cost of gasoline coming down. That's impacting it for sure. We all eat, but we also use energy as well, of course. And then cost of commodities, less food and energy. And I do have some commodity charts loaded up for you. You can see those going up. So that has me thinking about what I've shown you now a couple of times of late. And that is the relationship between Fed funds rates or Fed funds action or Fed action and inflation at certain times. I do want to show you that again, because here I am showing you what I think is the justification or the beginning of signs of justification for rate cuts later in the year. But at the same time, you've got inflation going in the wrong direction, and that's a concern of the Fed as well. So here again is that September 50 basis points cut to the Fed funds rate, 25% at the November meeting, 25% at the December meeting of last year. Okay. Now I've shown you mortgage rates, I've shown you treasury rates. Let's look at inflation swaps during that time period. These are CPI or inflation swap rates. What they do essentially is measure, some say market expectations, but really the compensation for investors who are hedging their inflation risk. And this shows that actually going up. So you could argue that, inflation was coming down, and it was on the earlier charts that I showed you, and that maybe the Fed could justify, tweaking rates a little lower because inflation was coming down. And that's the argument that politicians and people who really want the Fed to cut right now, that's the argument they're making. However, the timing was really bad, as you can see, because virtually immediately, upon probably the rumors, right? And then suddenly the market said, oh no, if you do that, you are going to spike inflation, or certainly inflation compensation, inflation expectations, which are embedded in here. And you saw it in the interest rates and so on. So this is the problem. I think this is the conundrum the Fed has. I think they need to wait for the data to weaken further, which we expect, by the way, before they start cutting rates. That's why we think a September, December rate cut makes some sense. And on that inflation theme, here's the Bloomberg Commodity Index over the past year. Here is the CRB Raw Industrials Index. So there's no futures traded on this, folks. This is just the bare bones cost of these commodities. And you can see, right, what's been happening of late, right? Does the Fed want to cut interest rates when we've got this underlying inflation that still looks pretty stubborn? Look at the price of copper, right? Is that, a hallmark of a great economy, or is it inflation and tariffs and these kinds of things? So that remains to be seen. And then the Baltic Dry Index, which has come down a bit here of late. This is the cost of shipping, across the world's oceans. You can see on a year-to-date basis, that's elevated as well. Okay, so I understand, the Fed's, complacency or patience here, despite, the push that they're getting from the administration to cut rates and cut them aggressively. I suspect the administration may be thinking they'd like to go bigger on the tariffs when the reciprocal tariff delay expires on July 9th, meaning bigger than what the market is discounting, and they'd like some help from the Fed. And by the way, that would, well, at first blush, you might think that could exacerbate the inflation, which it could, as long as companies can pass that cost through. It also, I think, puts a much darker cloud over the economy and supports that notion that things are going to get weaker as we go. What we've learned, though, is the market can definitely guide the hand of the administration on these things. So, like I said the other day, if the market holds up all the way into July 9th, and we'll look at what the charts are telling us right now, they may go heavier than expected on the tariffs. I think the market would react violently to that probably, and then you might see a change in attitude shortly thereafter. So again, all that remains to be seen. Okay, so looking at the technicals, here we are, S&P 500, bolting to new all-time highs, which means it's up now probably 5% on the year for the first half of the year. It was down 20% at one point from here to here. Here we are moving to new all-time highs. I'm here to tell you, folks, that this looks a lot like the gold chart, which I'm going to show you here, that's been concerning. And it looks like, the kind of chart that I've shown you over years now in these technicals that suggests this is not a breakout to buy into. These bearish divergences have to get burned through before our view of the technicals would get bullish. And clients who've been with us for years, while I haven't been bullish for a while, we can get very, very bullish from a technical perspective, and we just can't, given what we're seeing. Here we are, just eking up into new all-time highs with a bearish divergence on the MACD, and we're now overbought on the RSI. We shall see. This suggests to me that in the weeks to come, we could see some weakness in the market. In my view, the technicals are pointing to that. Doesn't have to happen. Could be a lot of good news on the international front. And by the way, today, it's pretty much, for the most part, a developed market phenomenon. Our Europe exposure is up over 1%, while the Dow is up about 0.86%, which is 370 points, which looks impressive. S&P's up about a half a point, so is the NASDAQ. All the while, our core allocation today is flat. It's up a few basis points. And that's because gold, for example, which we're going to talk about, is getting hit pretty hard today. We are hedging it, so we're mitigating like a third of the decline, but we're still feeling it. And then Latin America, South Africa, things that were up a bunch yesterday are giving some back today. What's really interesting, too, is that we have this weaker income and spending data, and we have bond yields that are actually rising. TLT, our long-term Treasury ETF, is actually down 0.36%. I'm going to show you the yield chart here in a second. That's counterintuitive. And I'm wondering just out loud, and this is just a day, so this does not a trend make, as we like to say, but I'm wondering if all this talk that the Fed is going to be cutting rates, you got people on the board who are getting more sympathetic to that, and all the while you have these inflation indicators that aren't going anywhere, right? And it could be that the market is saying, hey, it's going to be inflationary again if the Fed starts getting aggressive. Who knows? That would make sense. What would happen is rates would actually go up like they did at the end of last year. We'll see. As for the NASDAQ 100, looks like exactly the same chart, frankly, as the S&P. Today, moving into new all-time highs, marginal new highs. This is a divergent high, as I like to say, and one of my favorite technical analysts likes to say. Overbought, bearish divergence, not a warm and fuzzy look for stocks right here, even though it feels that way, at least for U.S. and European equities. The dollar, wow, who would have thought? Even with yields up today, the dollar is doing virtually nothing. Essentially, it's flat on the day, down from where it opened today. Oh, I did say that we'd talk about what I wrote about during the week. In fact, let me just pull that over. So I wrote a pretty brief, not all-encompassing, not by a long shot, but just really focused on one key to our bearish dollar thesis over the long run. And I still expect to see the dollar get stronger in the near term. Technically, it's way overdue for a bounce, I think. I'm seeing more and more talk about this. It's interesting to me because people really harp always on interest rate differentials. The countries with the higher interest rates should attract capital, right? You could do a carry trade where you borrow in a super cheap currency like the yen, which has been done historically cheap because interest rates were low, and you just stick that money in a foreign entity or a foreign institution where you could earn several times more interest than what you're paying on the loan. As long as the currencies behave, you can make a lot of money that way. So popular wisdom, conventional wisdom, popular opinion says interest rate differentials drive currencies. Well, I'm going to support that notion when I give you this historic case for why the dollar should be weaker going forward. But then I'm going to steal it back because it's just not happening, right? We've seen rates stubbornly high in the U.S. and we've seen the dollar continue to go down. And some people are saying, well, see, it doesn't work that way. And my point is, yes, it does. It just doesn't all the time. That's why we have to always pay attention to correlations at any given moment because things trade on different elements or different factors at different times. It all depends on what investors are most focused on, where the capital is going, or why the capital is going where it's going. We see very high odds of a declining trend stems from the fact that the U.S., we believe, has finally reached the point where the national debt is a serious problem, largely because we now have inflation and we have moved into, and this is a global phenomenon, I think, multi-year populist regime going forward. And that lends itself to structural inflation forces. We've talked a lot about this over the last couple of years, and we will talk more about it going forward. So something akin to the yield curve control strategy of World War II, post-World War II actually, but it started during World War II, is really on the menu ultimately. The U.S. won't default on its debt except for via inflation. It'll still pay its bills, but if it can devalue the dollar, then you pay for it with less valuable dollars than what you borrowed. So beginning with World War II in 1942 and ending in 1951, the Fed simply stepped in. We had all this war debt, short-term war debt to refinance, and basically bought up all the issuance that needed to. It filled the gaps to keep the long end of the curve at 2.5%, allowing the government to refinance its debt pile at low rates, all the while allowing inflation to run hot. Essentially, as I said, it inflated its way out of the debt burden by intentionally refinancing it with devalued dollars. The average annual inflation rate was 5.5%. It was as high as 14%. It was as low as slightly negative in 1949, but the average was 5.5% for that 6 years. So remember, we kept interest rates at 2.5%. Inflation was 5.5%. Therefore, the real yield when you adjust for inflation was people were losing money who were in treasuries at a clip of 3% annually. And of course, the dollar declined by a fourth during that stretch. So by allowing the economy to run high, essentially the debt to GDP plummeted from 119% to a very manageable 73% by 1951. So now, did they pay off any debt to get it there? No, of course not. What happened is they grew the economy, right? The economy is just the nominal value of all the goods and services. So if we don't have recession and people don't even have to buy anymore, but if you get 5-6% inflation, the GDP is growing by that much, right? So the GDP number grew faster than the debt number. And we woke up 6 years later and said, hey, we're in pretty good shape. We're presently at 124%. And I think we have, or will see, structurally higher inflation for quite some time. There's the opportunity. Somehow cap interest rates, right? And do that by essentially financing the government deficits to come. Now, in contrast to, or contrary to this notion that interest rate differentials always drive currencies, when we look at it in today's terms, wow, the dollar should be getting stronger. Why? Because here the U.S., using the 10-year yield, is sporting a 4.32% yield, right? Canada, 3.3. I did say save for Latin America. Brazil, 6.5. Argentina, 11. And we're bullish Latin America going forward for quite some time, by the way. And then you have the UK at 4.475. Other than that, we have the highest rates, virtually the highest rates, very close to it in the developed world. And you've seen what the dollar has been doing. U.S. 2-year yield, right? 3.75%. Canada, here's Brazil and Mexico, and then UK again, but we're higher than everybody else. There's that dollar index. So in summary, here's my main point, is when we combine present dynamics with our yield curve control narrative, we have all the makings of a trending lower dollar far into the future, which, by the way, is indeed the ideal backdrop for our global macro style of investing. And of course, we've seen that this year. We have quite the notable outperformance over things like U.S. equities on a year-to-date basis, because that's not all we're in. And I said, don't be surprised if you see a counter trend rally in the dollar. Technically, that makes a lot of sense to me. Okay, so let's jump to we looked at the dollar chart. Now we have yields. And this, first off, I just thought I'd show you today. It looks like they're coming down a little bit now. Yeah, TLT is only down 14 bips. So yields are beginning to come off today's boil, but you can see today they're still higher amid weaker economic data, save for the inflation numbers. And then on a 1-year charts, you can see the trend has been lower, and nothing compelling there that says they're going to pop higher anytime soon, despite today's little pop higher. And then gold is tanking today, still down 1.75%, off a little bit off the bottom. So you see the big gap today at the open on gold. And what have I been telling you now for quite some time? That gold looks very susceptible to me, technically speaking. And remember, earlier I said that the U.S. market looks a lot like the gold chart. Not quite as bad in terms of momentum divergence. This is a bad-looking chart. So as we were hitting these points, folks, I was telling you that this looks ugly for gold. And I said the other day that if we can lose this 50-day moving average with some momentum for a few days, it's going to go further down. So little resistance right here at 300 on GLD, the gold ETF. We break out of this trading zone, and I think we could probably find some pretty firm support. It'd probably be a buyer at the 200-day moving average. So as I said, we are hedging our gold position. We're up just fractionally today when the stock market's up more than that. So our GLD position is down 1%, 1.08%, when gold is down 1.7%. So we are mitigating about 35% of the decline. Okay, and that's the point. And we're right close to the money on our put options. So if it gets worse, that's going to perform even better and will mitigate more of the decline. So we have a pretty sizable position in gold. We just don't want that to be a huge drag over an extended period of time. It's definitely a drag today, which is okay. I mean, that's going to happen. Gold miners, which we aren't hedging, which we have a small position in, are down 4% today, so we're feeling that as well. Okay, so folks, I'll let you go, and don't expect that you'll hear from me over the weekend, except when I go through the exercises. If I think I'm just dying to share something with you, I'll throw something short out there. Other than that, hope you have a great weekend, and I'll talk to you next week. Take care. Bye-bye.